Good afternoon and Happy New Year, everyone. Thank you for joining us today. I do want to give a special welcome to the Patten and Dave's clients who joined the Cutler team in the last quarter. Thank you for being here and for joining our quarterly webinar and market outlook. I'm Erich Patten. I'm the Chief Investment Officer here at Cutler, and I'm joined by Stanley Barnes, who is a chartered financial analyst. And Stanley, go ahead and say hi.
Hello, thank you for having me, Eric.
Great. And we're going to jump right in here real quick. I want to start with, hold on. I'm getting a message that we need to wait. Please hold on 1 minute while we let other participants join us. So we're getting a rush of people here at 1:30 on the dot that are joining us. 1 second, please. All right, so we'll jump right into our disclosures here. Thank you for waiting. I did want to point out one item here in the disclosures that I think is particularly important, which is there is a risk of loss from an investment in securities, including the risk of loss of principal. I think that's important to point out because that's really why we invest. We do invest because there's a risk of loss, and that risk is what leads to return. And our job as advisors is to identify what's the right level of risk for you, what's the appropriate level of risk for you, because certain investments like cash have very little risk, while other investments might have a lot more risk. And we're going to talk through each of those investments today and really tell you how Cutler views all these different asset classes and how they might come together in a portfolio that makes sense for you. All right, so today's agenda, we're going to start with a market review and outlook. And what a fourth quarter we had. It really was a phenomenal Santa Claus rally and a finish to 2023. And then we're going to have our economic outlook, and we're going to talk about some risks to 2024. There's a lot of good news heading into this year. We're not going to sugarcoat that good news. We are going to talk about that. But we're also cognizant of the risks and the downside that might be out there. And we want to make sure that we're positioning portfolios accordingly. And then finally, new year, new you. Let's do some goal setting. We want to talk about what your investment goals might be this year. What are some things that you should think about as you enter into 2024? So Stanley, what happened in the fourth quarter? We got some bullet points on here, some real high level points about different asset classes, but can you give us a little more color on what we saw in the fourth quarter?
Yes, so starting off with bonds. Bonds had the best 2-month rally since 1982 in the last 2 months of the year, November and December. They rallied 8.5%, which is very, very large. Through the end of the third quarter, bonds were actually facing their third negative year in a row, which has never actually happened. So thanks to the fourth quarter rally, we actually had a positive year. The main reason is because the Federal Reserve is likely to cut interest rates, and markets started pricing in interest rate cuts in early 2024. Jerome Powell, the chairman of the Fed, also had some fairly dovish comments on likely cutting interest rates as well over that time period. So going off of that also affected the stock market. When looking at U.S. stocks, small and mid-cap stocks did extremely well throughout the quarter, gaining about 15%, whereas throughout the first 9 months of the year, they had only gained about 1%. Again, similar story. The Federal Reserve cutting interest rates in the future really should power charge the growth there. A lot of the smaller companies have near-term maturing debt, which they were going to have to roll over into very high interest rate debt. And now with likely lower interest rates, they'll be able to roll it over at a much lower interest rate. So it really should not hurt their financial statements quite as much. Going off of that, small and mid-cap stocks are really going into a period where they should hopefully outperform. They're trading at much lower valuations relative to large cap stocks. And so there should be some good opportunity there. Moving into foreign stocks. Foreign stocks are actually the third best performing asset class across the entire global market. They returned about 18 to 19%, which most people aren't even aware of. That's a very strong return for non-US stocks. Japan notably hit a 34-year high as well. They have struggled since the 1980s to get out of their real estate bubble, but they're actually starting to see some inflation and economic growth there as well. So we are very bullish on foreign stocks just because they trade at such a significant discount to US stocks overall. And finally, looking at the alternative investment class, generally speaking, we have a 10% allocation to alternatives. Because fixed income rates are really quite high now, we're actually considering lowering that allocation just because it's really not as much of a proxy anymore, and it's not as useful as having a higher fixed income allocation. So look at some possible changes there in the future as well.
Yeah, we use the term alternatives, and for us that means a specific fund that we might recommend in that asset class, but it can be a grab bag of a lot of different investments. So when you hear the word alternatives, usually what you should be thinking of is an investment that's not correlated to stocks or bonds that might behave a little bit differently. And there's a lot of different ways to approach that asset class. But let's look at we call this our quilt chart. This is because it looks like a quilt. This is what all these different asset classes did last year. You can see, it led the way. Large cap growth stocks up 43%, 42.68. The Magnificent Seven averaged 53% last year. And you can see 2022 was really the inverse of that. The last 2 years combined have really been, I think, a yin and yang to each other, where in 2022, large cap growth led the way down. In 2023, they led the way up. And the question that we're going to try to tackle today is what's going to happen in 2024. But one thing I'd like to point out on this chart is look at the bottom of the 2023 asset classes. You see short-term bonds. And short-term bonds are a good proxy, not a perfect proxy, for cash. And you can see last year they had a good year. They were up 4.89%, but relative to every other asset class, did not have a great year. In 2022, when everything was down, cash held up better than almost anything. But if you look at the last 15 years, short-term bonds have been in the bottom three for a good number of those years. I think it's 11 of those years, short-term bonds have been in the bottom three asset classes. And the question to ask then is, what role should cash have in a portfolio? What should investors be doing with their cash? And really, what we've seen them doing, and I think there's a lot of logic to this, is putting that cash in money market funds. So investors that might have money sitting in the bank a year ago, today are looking at a CD or a money market fund and saying, I can get over 5% in a money market. Why would I leave my cash in the bank? And this chart really shows the amount of money that has been flowing into money market funds at the start of 2024. Really, 2023, we saw quite a bit of that as well. So, Stanley, anything you'd like to add on money market?
Yeah, going off of that, if and when the Federal Reserve starts lowering rates, that will correspondingly lower the interest rate on money market funds as well. I would guess that a lot of people who have money in money market funds, they will start shifting that towards the equity market and fixed income market, which should juice it a little bit. But also a large portion of that money might go into consumer spending as well, which could mean that inflation sticks around for a little bit longer just because you're going to have more money being spent on goods and services.
Yeah, we refer to that as dry powder. And there's definitely a lot of dry powder ready to buy stocks. If we get a pullback, if we start to see some weakness, maybe some of that moves into the stock market. This next chart is the yield curve, the Treasury yield curve. And it has been inverted for a year and a half. And inverted has generally been a recession indicator, but the yield curve is becoming less inverted. And the reason is the expectation that the Fed is going to cut rates. And we've really highlighted that in the red oval here. You can see the precipitous drop in rates that is predicted over the next 6 months to 2 years. And what that means is that your cash return, your money market return, which today at 5.25 roughly for a money market, is going to be, we're going to anticipate a drop in that interest rate over the course of 2024. And by the end of the year, those money market funds may not be nearly as attractive as they are today. For short-term investors, short-term cash or cash that's not appropriate for the stock or the bond market, that remains a great vehicle. But I think now is a great time for investors to think about what the purpose is for those cash investments, and if it's if it's long term, if it's something that they're looking for gains in, they should consider other investments at this time. All right, so what could go right in 2024? And there's a lot of good news out there, and you're starting to see economists and Wall Street banks and investment banks really um, talk up the possibility that there may not be a recession, that we might not have a soft landing at all. In fact, it could just be the economy continuing to take off. And on this chart, we've shown just a few names, and obviously there's hundreds of people we could have included in terms of uh, what's in store for 2024. But for the most part, those Wall Street watchers are pretty bullish and are anticipating gains in the stock market. Few and far between, we do see some that are a little bit more defensive, a little bit more cautious. But the reasons for being bullish remain that unemployment is very low, that inflation has come down. We'll have lots of charts on inflation over the next few slides. And then the Fed is easing. And that combination is giving investors a lot of optimism. So that's what they are saying. And the question is, what are we saying in 2024? And we do agree that there is a tailwind heading into 2024, and investors should continue to overweight stocks. But we also believe that they should focus on valuation and income because certain portions of the stock market have become, in our view, overvalued, while a lot of different asset classes are undervalued or historically valued right where they should be. And so as we head into 2024, we want investors thinking about valuation and thinking about income. Two great things to rely on as an investor are to look at what's the value you're paying and what's the income that investment pays. For bond investors, that income is very important as well. But let's talk a little bit about valuation, Stanley.
Yes, so looking at this chart, you can see that from January 3rd, 2022 until December 31st of this past year, there was really very little change from the beginning to the end of the index level of the S&P 500. Yes, it went down quite a bit, but it came right back up. It's about flat over that time period. Now, the one big difference is if you look at the price to earnings ratio, it's gone down from about 21.4 times earnings to about 19.5. So you've had about a 9 to 10% earnings growth over that time period, which over the long term, earnings growth is the driver of the stock. Now, when looking over the long term, again, that 10% earnings growth is about in line with what happens over the long term. The S&P 500 has done about 10% over the long term. Now, there is a pretty big difference in that the mega cap stocks, the top 10, they were the primary generator of returns, whereas the bottom 490 stocks did not generate nearly as much of a return over that time period. So keep in mind when you're buying stocks, you're buying a piece of the future profits. And yes, stocks are volatile, but over the long term, they tend to go. Now, digging down into the individual components of the S&P 500, the top 10 stocks of the S&P 500, the Magnificent Seven being a part of those, their share of the return over the past year was about 86%. And they're currently trading at 27 times earnings, which is a pretty lofty valuation. If you look at the remaining 490 stocks in the S&P 500, they're trading at about 17 times earnings. Not anything super high. Looking at mid-cap stocks, they're trading about 16 times earnings, and small caps in the US are about 15 times earnings. So you really have a segmented market where you have the top 10 stocks trading at 27%, 27 times earnings, and the rest of the market is at 15 to 17 times earnings. On a relative valuation, you're looking at a lot better deals in the smaller piece of the market than you are looking at the top 10 stocks. Going off of that, top 10, they account for 32% of the S&P 500 market cap. That's an all-time high. They're only 23% of the earnings of the S&P 500. So again, looking at the bottom 490 stocks and smaller, a lot better deal buying those than the top 10. Now, that being said, we do have holdings in the top 10, so we don't dislike any of these companies. We just think there's better deals in the smaller ones.
Yeah, when we say the Magnificent Seven, really what we're referring to are those seven stocks that have led the market higher last year. You can see them in the fine print down here, but I'll just list them for everybody. Apple, Microsoft, Amazon, Nvidia, Google, Facebook, and Tesla. So that's a term that we've come to know over the last year called the Magnificent Seven. Another way to segment the market, and those seven stocks are for the most part considered growth. They're fast growing, more expensive stocks. You pay for that growth through a higher multiple, through a higher price to earnings ratio. But this chart compares value stocks with growth stocks over the last 15 years, sorry, 25 years. And you can see today growth stocks are trading at 26.5. Historically, that averages about 21. Value stocks are trading at 14.9. Historically, that average is about 14.1. So value stocks, you can see, are trading pretty much in line with the historical valuations. Growth stocks are a lot more expensive. And the question you would ask is why? Well, there's several reasons why, but one of those was really this craze toward artificial intelligence, right? The desire to get in on the artificial intelligence trend before it became the next big thing. And we've really seen that drive some of these stocks higher over the last year. Another reason why was really a rebound from the previous year. We showed on our quilt chart how large cap growth led the market lower, and 2023 was really a recovery as the market maybe anticipates less recession risk and more economic growth. So let's talk about what could possibly go wrong in 2024. And we're not going to talk about kind of those black swan events, those exogenous events like a war or things like that. We're going to keep our comments to more economic. But with low unemployment, we've talked about employment below 4%, lower inflation, and an accommodative Fed. There's a lot of good news. What could sidetrack that? And the first risk really is, are we going to have a recession? Is a recession going to sidetrack that? And Stanley, this chart shows the historical trends of recession and interest rate cycles.
Yes, so the key thing to note here is that 7 out of the past 9 times the Federal Reserve has raised rates, it has resulted in a recession. The Federal Reserve is known for, and I quote, killing the recovery. They are aiming for a soft landing here. We'll see if they're able to do that. What they're going to need to do is lower interest rates as inflation falls to encourage banks to lend and encourage people to borrow and keep that demand recurring. We'll see if they can do it. They don't have a great history of being able to do it, but they have been able to do it before.
Right. So really the question this raises to me is this time different? Right. And there's reasons to think it might be, and the numbers have suggested it might be different. But let's look at this next chart, which quite honestly, I mentioned at the start that we're optimistic, that we believe investors should continue to overweight stocks. This is the most negative chart we're going to show you today. It's probably the least good news, which is the leading economic indicators index continues to be negative, and it continues to be negative in a way that strongly suggests that the U.S. economy is headed into a recession. Now, if we do have a recession, we think it would be a very shallow recession based on some of the numbers we're going to show you in the next few slides: consumer health, unemployment, things like that. But this does suggest there's likely to be a recession. One thing, the bit of good news on here is that you can see these indicators have strongly turned positive or turned up. They're still negative, but there's definitely a trend toward positive and an improvement. So that is good to see. Some of those indicators and things include things like the yield curve inverted. We mentioned the yield curve has become less inverted. Also, stock market prices are a leading economic indicator, and stock market prices have been doing very well. So this is definitely a risk. Some economists have predicted a rolling recession, where you've seen recessions in various sectors of the economy, not the whole economy at once. That's a little bit of splitting hairs there, but definitely something that could happen as we head into 2024. On the flip side of that, growth has been very strong. So it's difficult to have a recession when you have lowering interest rates as well as strong growth. And this chart is hot off the presses. This is yesterday's Atlanta Fed estimate for the fourth quarter, came in at 2.4% growth, not nearly as strong as the 4.8% growth we saw in the third quarter, but still a very acceptable range. And you can see here the blue chip consensus are what economic forecasters are predicting for growth in that quarter, and it's somewhere between 0.8 and 2.4. The Atlanta Fed is saying we're going to hit the top end of that market, so or of that prediction. So really, growth has been strong, and most forecasts have growth continuing into the first quarter of this year.
One thing to note there too, Eric, is that the expansion really has been fairly broad. The biggest positives of the most recent quarter were from housing starts, manufacturing, and auto sales, all of which were highly cyclical areas, but they're also, fairly broad areas as well. We've also had very strong real wage growth too. So the U.S. economy and consumer demand is doing exceptionally well, especially relative.
Yeah, and you said consumer demand there. One thing to point out on this chart, of the 2.4%, 1.9 is consumer spending. So we very much still have a consumer-focused economy, and the consumer is healthy. We're going to show you the same chart that we've shown you over the last several quarters in a few slides, but the bottom line of that chart is, yes, the consumer is doing very well. What about inflation? Stanley, where are we on inflation expectations?
Yeah, so this chart right here shows inflation expectations, and as you can see, they went up quite a bit during 2021 and 2022, and now they've been trending down for the last year. The good thing is we're getting closer and closer to the Federal Reserve's 2% target. We're still not quite there yet, but we are getting closer. A lot of the inflation indicators have been going down, so overall, if we keep on going along this trend line, we should be in a good spot here in the next couple months.
Yeah, and what's interesting about inflation is it can be a self-fulfilling prophecy. This chart is not actual inflation. It is inflation expectations. And if consumers expect inflation of around 2% and businesses expect inflation of around 2%, they're going to set their spending, and they're going to set their prices as a business based on that expectation. And a lot of times that becomes what inflation is. So this is good news that inflation expectations remain anchored. They did get much higher. You can see inflation really looks just like this chart as it followed those expectations higher and then back down. So those lower inflation, Stanley, have led to what? We're looking at a Bloomberg printout here. What is this Bloomberg printout of?
So this shows all the Federal Reserve upcoming meetings, the board meetings in Jackson Hole, and it shows each meeting the chances of a rate hike cut and how much that cut will be. So the number of cuts is the hikes over cuts, and we're looking at over the next year from now through January 29th, 2025. The market is expecting 7 cuts over that time, and each cut would be 25 basis points. So all in all, they're expecting a 1.75% interest rate cut over the next year. I don't know if we're quite that bullish. It probably won't be quite that much, and I think a lot of other analysts are of the same opinion. But overall, the market is expecting seven rate cuts. Most of those rate cuts should come in the middle of the year. So looking at the next column, the hikes over cuts, there's a 112% chance of a rate cut on May 1st. And that would be total rate cuts as well. So right there, the big bulk of the cut should come in the middle of the year before the election. The Federal Reserve doesn't want to be seen as, pushing one way or the other as the election goes. They're supposed to be nonpartisan. So if and when they start cutting rates, it should come in the beginning to the middle of the year. Very unlikely to be cutting as much near the end of the year. Then again, it does really depend on when data comes in. The implied rate, according to the market, by January of next year should be 3.5%. Again, I don't know if we think it'll get that low, but rates are almost certain to go lower. Going along with that, money market fund rates will also go lower as well, in line with the Federal Reserve discount window.
Right. So we're looking at a year from now of money market rates at 3.5%. Cutler's view has historically been during this cycle higher for longer, and I think we would still maintain that higher for longer. So maybe not seeing all of these cuts, depending on how well the economy holds up. And the real question on how much flexibility the Fed has comes down to what is inflation going to do. And you can see core PCE here on the left side, which is the Fed's preferred measure of inflation, is below that 2% threshold. And really, in the last CPI print, which is the largest or the most well-known inflation measure, the biggest component of inflation in the CPI was owner equivalent rent, which is shelter. We're still seeing rents not coming down as fast as the Federal Reserve would like, but the rest of the economy seems to be deflating a little bit, or at least not increasing at the rate that it has been over the last few years. I included this chart on the right just because I think it's very interesting. We spent a lot of time 2 years ago talking about the Port of Long Beach and the amount of container ships that were piled up. We couldn't unload them. It was a logistics nightmare. We talked about a semiconductor chip shortage that was leading to a shortage of autos, and auto prices were escalating. You can see that back up here between 2020 and 2021 as the number of container ships soared, right? This is imports measured in 20-foot equivalent units. So think of container ships. Well, we're back down to 2020 levels now, much more manageable. We're not hearing about those logistical backups. That all is deflationary. That helps those supply chain improvements help the overall inflation pressure and do give the Fed some latitude to lower rates. All right, risk number 3. So the first was recession, second is inflation, and now debt. We hear a lot about debt. It seems like Congress is in a debt crisis or a debt ceiling crisis constantly. Stanley, what's going on with debt, and is that a problem for us as investors?
Yes. So looking at the bottom right chart, you will see federal net debt as a percentage of GDP. We're near an all-time high. It actually went down a little bit over the last couple of years due to the high inflation inflating away our debt balance, but it is expected to continue to go up. As everybody knows, we run a pretty large deficit, close to $1.7 trillion for this year. A big piece of that for the year, looking at the top right chart, is actually interest expense. Because interest rates have gone higher, we're now having to pay a higher interest rate expense on a lot of that debt. And if interest rates stay high, as we roll over some of our existing debt, especially the long-term debt, that interest rate expense will go up. Now, if the Federal Reserve starts lowering rates, that correspondingly should lower our interest rate expense as well. Overall, the U.S. federal government is fine. We have the ability to raise taxes. The Federal Reserve, they can buy debt. They have the ability to lower rates and really lower that interest rate expense. But even with our high debt levels, it's really not that much compared to other developed countries, and we're still in a pretty strong spot. It's something to definitely watch over the long term, but in the here and now, it should not be a major issue.
Well, you look at us at 97%, Japan at 280%, and Japan is definitely an outlier. They've been dealing with deflation for a long time. I think all investors would like to see this number lower. The question is this something that's going to sideline the stock market or tank the stock market? And in our view, it's not to a level that would be concerning for a stock investor or a bond investor at this time.
And one other quick item to note is demographically, the US still has a growing population. In some of these other developed countries, they actually have shrinking populations. That could be a really serious problem for them. For the US, not so.
Right. So one thing that has happened over the last few years is we've shifted private debt to public debt. So consumers are actually in great shape. And the government finances may not be in as good of shape. A big reason for that has been the stimulus, right? So the government borrowed, paid that money to consumers. Consumers look great. The government does not, but the whole society is in a similar position. You can see today our debt service ratio is close to 10%. That's a tick below where we had been for most of the 2010s. So we're near, other than that pandemic area blip, we're near all-time lows here, or the last 50-year lows in household debt services or service. Households are in great shape. You can see the household balance sheet there on the left side. Again, the assets to liabilities continues to be very attractive. In the middle bottom, this is where there are some concerns. You see auto loan rates, delinquency rates, and credit card rates are much higher than they have been over the last few years, and that largely has to do with the level of interest rates. So some lowering of interest rates would definitely ease pressure in both the auto and credit card space.
One key thing I want to point out here too, Eric, is if you look at the liabilities on the chart on the left, 2/3 of it is in mortgages. The vast majority of mortgages in the US are in either 15-year or 30-year fixed rate loans. So most of those mortgages are going to be in the 3 to 5% range, maybe some in the 2 to 3%. Those are locked in for the long term. And mortgage holders, they're not going to be paying that off quickly when we have a high interest rate. So you can invest your money in a money market fund yielding 5.25%. So, again, the consumer is in really good shape. That mortgage balance being the vast bulk of the debt, most of the interest expense there is really, really small compared to current markets.
All right, so let's set some goals for 2024. What can you do as an investor? What can you control? And the first, Stanley, what's the first goal we're going to set? It's don't let politics get in the way of a good time.
Exactly. So, everybody has political opinions, including Eric and myself, whether one way or the other. The good thing is whoever gets elected, on average, returns are positive. So, whether you hate one party or love one party, you should stay in the market in general, just because on average, getting out of the market because of a certain politician getting elected or not getting elected, it doesn't affect the returns massively to the point where they're still going to be positive. It's one of those things where staying in the market is your friend. Time spent in the market is more important than timing.
Absolutely, and we're gonna talk about that on goal number 3 as well. But the second goal is diversification and maintaining your diversification. And we included a slide here showing domestic versus international outperformance. Stanley, what do you want to point out here on this slide?
Yes. So, different markets have different periods of outperformance. Over the last 14 years, up until the most recent bear market, the US market, especially the large cap growth companies, heavily outperform international stocks. But there have also been periods where international outperforms US. And over the last 2 years, international has actually outperformed the US. And people probably are not aware of that. But on the downside, international did quite a bit better. What I would also point out is the fact that currently, international developed stocks traded about a 30 to 35 to 40% price to earnings discount to US stocks. So they're a lot cheaper to buy the same profits. And then if you look at emerging markets, they're trading at about a 15% discount. So, I would not be surprised if international stocks have a pretty strong period of outperformance here in the near future. It's not guaranteed, but going off of the valuations, international stocks trade at a significant discount. In addition to that, we have a very strong US dollar right now. Historically, as inflation has fallen, international currencies tend to outperform the US dollar, and the US dollar weakens as well, just because we're considered the safe haven currency as the world's reserve currency. There is a lot of ammunition for international stocks to outperform the US. Again, not guaranteed, but just the internal profitability is very high for them, and they're trading at significant valuation discounts to the US.
Yeah, the strength of the US dollar has really been twofold. One is just the US economy and the strength of the US economy. But the other has been, of late, interest rate differentials. And Stanley, I threw this slide in at the last minute. This just shows the US interest rates versus the largest central banks around the world, the Bank of England, the Bank of China, the European Central Bank, and the Bank of Japan. And you can see the US is the highest of all those central banks. Well, that scenario is likely to change over 2024, and the US is now forecast to cut rates more aggressively than the rest of the world. And the US dollar may potentially follow that interest rate differential as the US lowers rates. So that's something to be aware of in 2024. Our next goal is don't become a market timer. And everybody is tempted to time the market, but most of the time, that does investors a disservice. And this chart shows what the S&P does after a big up year, and big up years defined here as 10% or more. And over 30% of the time, the S&P follows a big up year with another big up year. And some of those big up years are even 20% or more. And that just goes to show that you can't necessarily predict what the stock market is going to do over the short term. There's a lot of different influences in the short term. Maintain a focus on your goals and don't try to pick the top of the market in order to cash out your portfolio. Here's another market timing slide that I think is really interesting. This shows over the last 44 years, the S&P 500 was positive 33 of those years. So about 75% of the time, it was positive. Despite the fact that it was positive 75% of the time, it averaged 14% drops over the last 44 years. So the stock market is likely to drop 14% at some point this year. And when you look at your portfolio and you look at your investments, you think, oh, everything has gone down. That's a normal part of the stock market. That's what investments are supposed to do. They're supposed to go up over the long term, but they have volatility in the short term. It's something to get comfortable with. Stocks do go up, they do go down, on average 14.2%. And it's difficult, if not impossible, to get the exact timing of that investment correct. So we aren't recommending that you try to do it. Instead, stay invested, stay in your diversified portfolio that has been built for your investment goals.
Eric, one thing to add there too is corrections are a good and healthy part of the market. And what company management teams will do is when they engage in share buybacks, they will oftentimes try and time it for when they think the stock is undervalued. And if a correction happens, they're going to do a lot more share buybacks at that time. So what I would say is, as far as timing the market, let the company management teams determine with their own internally generated earnings, let them decide when is a good time to buy back shares and quote unquote get into the market. That's really their job to do, and they know how to do that. The CFO of the company is going to know when to engage in share buybacks versus when not to engage. It's a lot harder for outside investors.
Thank you. Yeah, and our final goal is really a shout out to our financial advisory team here at Cutler. They have a lot of experience in a lot of different topics, and we've just thrown some of those on this slide, but we want you to talk to us about your financial needs this year. Whether that's your investments, like Stanley and I are talking today about the markets and your investment outlook, a portfolio review, but that could extend to stock options or employee stock option plans or your rental homes. Look at estate plannings and talk to us about your wills and living trusts and anticipated inheritance. What about financial projections? That's traditional financial planning type of stuff, a Monte Carlo analysis of how much money you will have in retirement, or even tax planning and looking at tax optimization strategies. We are not tax experts at Cutler, but we do have tools that will look at your tax return and maybe assess what some tax efficiency opportunities are for you going forward. Reach out to your advisor, ask some of these questions, bring us your needs and your questions about your financial situation, and we'll tap our internal resources to make sure we're answering those as best we can. Look forward to webinars throughout the year on some of these topics. We will, in addition to our quarterly market update, also be providing webinars that may talk about, for example, why a Roth conversion might be advantageous. With that ends our goal setting for today. I do want to just thank you. We got off to a little bit of a rocky start. I think I jumped the gun before a lot of people got into our webinar. So I do want to repeat thank you to the Patten and Dave's clients who joined us for the first time this quarter. We appreciate you having you on board and are glad to be here, or glad that you're here with us. And thank you so much. If you have any questions, both Stanley and myself are available to answer anything that we have discussed herein. But with that, we are concluded, and have a great 2024, everybody.